But when I was thinking about these topics, there was a film that immediately came to mind, which, you know, in terms of what corporate America is all about, or at least what was it about, you know, about 20 or 30 years ago. And so I'm going to read a very short excerpt from a scene in that film. Those of you who have seen it will remember what this is, but I'll give you the antagonist's name, and many of you will remember this was Gordon Gekko. I kind of feel bad that I didn't grow my hair back and slick it back, but I did have it that way at one point. Hopefully I didn't have his ethics. But this is a scene where he was addressing the shareholders, if you remember this, of Teldar Paper, which was the company that he wanted Charlie Sheen to help him take over and then split apart. So the scene went something like this, and this was his kind of diatribe. America has become a second-rate power. Its trade deficit and its fiscal deficit are at nightmare proportions. Now, in the days of the free market, when our country was a top industrial power, there was accountability to the stockholder. The Carnegies, the Mellons, the men that built the great industrial empire made sure of it because it was their money at stake. Today, management has no stake in the company at all. Together, these men sitting up here own less than 3% of your company. And where does Mr. Cromwell put his $1 million salary? Not in Teldar Paper stock. He owns less than 1%. You own the company. That's right, you, the stockholder. And you are all being royally screwed over by these bureaucrats with their steak lunches, their hunting and fishing trips, their corporate jets, and their golden parachutes. Now, think about this. This film was released in 1987, just 2 months after the Dow Jones Industrial Average plunged 508 points on what became years later came to be called Black Monday. The governance and executive compensation issues that Gekko points out, however, are eerily familiar today. Aligning management objectives with and executive compensation issues, board accountability, equity ownership, management perks, and executive compensation, although we could argue that those really were the good old days. Think about this, when a CEO only made $1 million, and we thought that was crazy back then. And shareholders like us, we lacked any real power. But think fast forward a few years to the global financial crisis of 2007 and 2008. And as a result of the mass destruction of wealth, and to attempt to prevent similar financial devastation in the future, think about that where we are today, President Obama signed the Dodd-Frank Wall Street Reform and Consumer Protection Act, say that 3 times fast, on July 21st, 2010. And it contains sweeping legislation targeting corporate governance and executive compensation, plus a few other things thrown in there in the mix. And here's a handful of items that were included as part of the legislation when it was talking about corporate governance and executive compensation. Items like pay versus performance, internal pay equity, hedging of assets, separation of chair and CEO roles, something called say on pay. We'll talk a little bit more about that in a minute. Golden parachute compensation, again, Mr. Gekko. Broker voting on directors, compensation, and other significant matters, not letting brokers vote on these important items anymore. Access to the proxy statement by the average shareholder, being able to put up for election director nominees. Compensation committee and advisor independence, and clawback provisions in the case of a material misstatement of financial wrongdoing. So think about some of this. Some of you probably have heard the most recent proposal by the SEC. And by the way, if your head's kind of spinning just at these, think about what the SEC is trying to do in terms of trying to implement all these. About half of these have been implemented. The other half are in progress. The most recent one is the internal pay equity ratio. So in other words, the rule will be designed to tell us how many times the CEO makes, how much his or her pay is greater than the median employee of the company. Now, I talked to a bunch of companies about this in the last several weeks. None of them want to do this. I'm not sure as investors what it's really going to tell us other than what we already know because of current disclosures, which is executives tend to make a lot of money. What's interesting, and I proposed this to a couple of companies, I said you should hold a contest or at least give an award and point out who the median employees, maybe they get an extra bonus or something, or maybe they get a plaque for that period of time for a month. But the problem is there is so much going on out there. The SEC and other regulators can't possibly keep up with it, and that's a real challenge for them. But we're going to talk about a couple of these provisions, and I mentioned one of those already, and that is what's commonly called say on pay. The rule, Dodd-Frank law, requires public companies to place a proposal on their proxy statement every year now that allows shareholders like us to vote on whether or not we think the executive compensation practices at that particular company are appropriate, are reasonable, are challenging, are linked to results. And it's quickly become, and like I said, it's called an advisory vote on compensation. That's its technical name. We like to call it say on pay. That's pretty basic. And then what has happened here is it's become a lightning rod for shareholders and companies alike. You probably heard the term shareholder activism. We had the spring of shareholder activists earlier this year. Activism is exactly what it sounds like. The question is, what are we active about? Are we active because we want to make companies better? Are we active just because we can be as shareholders? Or are we active for another reason? And there's different classes of activists. My firm is essentially what's called an active investor. That means we actually go out and pick stocks as opposed to a passive investor who just invests in a basket of stocks, usually that mirrors an index. Are we activists because we actively invest? On the one hand, I could argue, no, we're not. We're not, because we're not seeking to put shareholder proposals on the proxy statement to try to get companies to change what they're doing. But we do vote on every proposal that we get on behalf of our own shareholders. So you could argue the flip side of that, in that, yes, we are active, and we may be activists. We just happen to like to do it behind the scenes in conversations that we like to think are constructive, rather than trying to stir up a hornet's nest. And here's where I'm going to get a little bit on my soapbox. Forgive me for that. But you have to be careful today. You have to really decide what the goals that you have are going to be. Are you really trying to do good for yourself as an investor and for the country in terms of our market economy? Or do you really have a misguided sense of what right and wrong are, and just because somebody makes $10 million, that must automatically mean that they're wrong? Those are questions. And by the way, hopefully what happens here tonight is you all come away with a lot more questions than you came in with, because that's what really starts activism, right? That's what makes things happen. The questions are the impetus for really improving anything that you want to do, and corporate governance is no exception there. So let's think about this. Let's talk about say on pay for a minute. If you read the financial publications, you read the websites, you listen to the news, say on pay is a huge deal for people like me and for thousands of other institutional investors, because we control millions and millions of dollars in invested capital. The ability for us to essentially give a thumbs up or a thumbs down, and that's a vast oversimplification, on a company's compensation practices is a huge, huge win for us as shareholders. Whoa, look, okay, you get a prize. I don't know what it is yet, but you're the first question out of the box.
Well, when you say on pay, but you're saying it's advisory, so you really don't get to control what they do.
Right. Thank you. You just got my next point for me. And that's right. And that's absolutely right. These are not binding, what we call binding proposals. So even if a majority of shareholders don't support a say on pay proposal at a given company, the company isn't bound to do anything by law. Now, think about the world in which we live. Think about media. Think about Twitter. Think about Facebook. Think about any other type of media that you can get to on the internet, and think about how fast that information comes out. So let me give you a couple of statistics, and then we'll talk about really what these say on pay results are doing and why they're important. But listen, I mean, everybody reads this every day, right? You've got, for example, 98% of all the proposals so far this year on executive compensation were approved. 98%. That's the Russell 3000 and the S&P 500. 98% were approved. Where's the problem? I thought everybody was up in arms because executives were making just gobs of money. Well, you wouldn't know it based on the statistics. Over 75% of the proposals received greater than 90% support. All you need is a minimum of 50 plus 1% support. That's a majority vote, and technically you're in business. What's interesting is companies have kind of drawn an arbitrary line that says if we got less than 8%, we know we have a problem. And that's a big kicker. That's a big plus for what this provision has done. Think about this, the final statistics. Only about 2% of all these proposals at thousands of companies failed. 2%. So the question is, okay, wait a minute. On the one hand, we're saying, corporate governance, executive comp, there's a disconnect. Executives are making millions of dollars. What's going on here? On the other hand, we have an opportunity to voice our opinion every year that a company will put this proposal on their proxy statement. So what's happening? I don't know the answer to that. I can tell you that in our case, we vote against roughly 30% of all of the proposals that we get. Now, you say, well, 30%, that's not a lot, but if you think about, voting against 30% of over 2,000, opportunities that we have, it actually ends up adding up to be a fairly significant number over time. But let's talk about, a couple of cases, because, thinking back to my Animal House reference, is this a case where you remember Kevin Bacon at the end of the movie and he holds his hands up and goes, "Remain calm, all is well"? Is this one of those cases? Is everything really fine in the executive suite with respect to pay? Here's a couple of recent examples. You probably heard or read about McKesson Corporation. McKesson Corporation delivers medical supplies, equipment, and drugs. They're the largest distributor of medical devices and drugs in the world. They received 22% support for their say on pay proposal this year. 22% out of, think about that. That was probably one of the worst. I mean, it's kind of like SAT. I thought you got 22% just for putting the proposal on your proxy or signing your name on the SAT. 22%, you can kind of get this in your head. Yes, ma'am.
Do you know how much they were going to pay their executive?
I'm gonna tell you that.
Okay.
What's your name? You should just come up here and help me do this. Here's the kicker. John Hammergren, who's the CEO and a very smart guy and a very good CEO. And McKesson is a company whose stock has done extremely well, and they've had, with the exception of a few bumps over the last couple of years, an amazing long-term return for shareholders. But last year he made $52 million. Okay? Yeah, part of that was deferred because it was in stock options and restricted stock. But it was still, the board of directors intended him to be paid based on the metrics they were going to be using over a 3-year period, $52 million. But the bigger point was, he has a pension plan, as do most corporate executives. And far be it for me to say that an executive shouldn't have a good and robust pension plan. The problem is, this was worth about $159 million. And that's a problem for most people. It's certainly a problem for me. I'm looking around the room and seeing your faces, and it's clearly a problem for you too. And it was obviously a problem for McKesson shareholders, and that's why that vote was so low at 22%. I sat on 3 separate calls with folks at McKesson and talked about these issues. And I can't go into any of the details of the calls, but suffice it to say, we were not satisfied with the answers that we received. I think they're going to make a number of changes going forward. I know those folks pretty well now after having talked to them over the past several years. The problem is these things, and this goes back to my point about media and what are the impacts of these, these votes. This is going to stick with them for a while because you can't turn a compensation chip on a dime, especially for someone who's averaged somewhere about $45 million over the past 3 years. You just can't. And there are a lot of reasons you can, and you can probably think of most of them. But here's what we try to do. We try to help them do that. And we realize it's an uphill battle. Investors realize that, I hope. I know we do. But we're duty-bound to tell them what we think, what our position is, and why we think it's appropriate that they reconsider some of these policies. Now, does that mean they're going to go out and implement anything that we say right away? That would be impossible. But a lot of companies, thanks to this particular vote, are not only engaging with shareholders more than they ever have before. Most of the time, the topic of that engagement is executive compensation. I mean, that's the thing that's right out there in front for all of us to see. Here's the second example, and you might know this little company. It just helped win the America's Cup, Oracle. Larry Ellison is another exceptionally bright and smart guy, and it's his company. He takes $1 a year as his salary. It's kind of symbolic. Okay, I can get behind that. What we have trouble getting behind is what his bonus is in terms of stock. Now, Oracle received 41% support on their say on pay vote last year. They've got, their shareholder meeting is coming up next month. But last year in November, 41%. What was the main reason? He got a stock option grant at the value on the date he got it was $91 million.
What?
$91 million. Now, You can argue that he probably doesn't need $91 million because he owns two America's Cup boats. I would argue that's probably true. But he did win, and so come on, we've got to cut him a little bit of slack here. But the argument is, okay, he's making and has been making, now granted, these are stock options, right? So they only really have value if, sometime in the future, whenever after they vest, the stock price of the company has increased. But he's exercised somewhere in the neighborhood of $250 million worth of in-the-money stock options over the past 5 years. So I don't think he's doing too badly, and shareholders essentially rose up and said, we can't support a $91 million stock grant year in. Now, it's not $91 million every year, obviously. It depends on what the value of the stock was at the time it was issued. But $91 million, I think my heirs for 100 years could live off $91 million, and I think that's the average investor. That's what we see. As institutional investors, we can make a case for Larry Ellison, and I realize that's going to kind of sound like a double standard, but we can. He is Oracle. He's the man. It's his company. He's the driving force behind Oracle. So whatever he gets paid, he's worth it because of the shareholder value that we realized as long-term shareholders of Oracle. That being said, we still think it's appropriate to send a message. We have to send a message that says, look, despite all of that, it's just an unreasonable number, no matter what you say. And that's the thing that gets out of the media. That's the thing that companies are worried about. You can't go and hide anymore because of all of this is disclosed in a proxy statement. How they determine an executive's compensation, what metrics they use to benchmark the achievement, how much they get in option grants, how much they get in base salary, how much they get in an annual cash bonus. These things are all out there in the public purview now. And so we all have an opportunity. And I would argue it's probably something that we need to do. And that is look hard and ask the hard questions. And that's what we try to do as institutional investors. We ask the hard questions. Now, size matters, right? When you have the amount of money under management that we do, companies will tend to listen to us more than they will to me with my 100 shares. And that's very important. So we have a fiduciary obligation when we deal with these issues to go and talk to companies and really try to understand why it is philosophically that they're doing what they're doing, not only with compensation, but all of that interacts to make the operational results of the company. And that's why we utilize our investment analysts as the key driver of this whole process. They're the closest to these companies. They follow the companies. So it then follows that they need to be involved in every vote that we submit on behalf of our shareholders at a proxy and shareholder meeting. So if you think about it, these votes again are about accountability and transparency. And I think they've done an incredible job at pulling back the veil of what goes on not only at the company, but in the boardroom. I mean, let's face it, none of us knows what goes on behind the scenes in the boardroom. We're not privy to it. There's no requirements to show us the corporate minutes unless we're done so in the form of a lawsuit. We don't know. So we have to take them somewhat on face value when they come to us and tell us what their philosophy is. And one of the things we try to do at Capital is to talk to companies and tell them, look, explain to us the story. I don't know if any of you are insomniacs. If you're having trouble sleeping, just try to read the proxy statement late at night. I think that'll take care of the problem for you. But one of the things we encourage companies to do is to write in plain English. I'm sure all of us have heard this a time or two. I'm sure some of your professors have probably reminded you a time or two to write in plain English. But the average investor doesn't, it's very hard to even understand all the data and the numbers, let alone the fact that it's really the proxy statement. Who's read a proxy statement in the room? I'm very sorry for you. Good for you, all the rest of you. I'm not falling into it. But like I said, if you're having trouble, pull a proxy statement some night. You'll have a great night's sleep. But the problem with a proxy statement is it's a legal document. There are specific legal requirements of the elements that have to be in a proxy statement. Guess who it's written by? With all due respect to any lawyers in the room, it's written primarily by lawyers. And I understand that. As investors, we understand that. They have to have certain things disclosed in certain ways. What the Dodd-Frank Act has done is to help companies understand that we need better and clearer disclosure. The better and clearer disclosure that we get from the corporates, the better we can informed we are, the more we can understand what we're voting on all of these proposals, and hopefully, the better the company ultimately will do for us in terms of its operational results. But my colleagues and I, so far this year, we've met with over 150 companies to talk about corporate governance. And as I said before, almost every one of those conversations starts off with executive compensation, especially if a company has gotten a low vote as a result of the say on pay requirement. So again, it's a great opportunity for those of you that are shareholders. If there's one proposal I would encourage you to read the fine print on and vote, it's the say on pay proposals. You will learn more from reading that part of the proxy statement about what's going on at the company, what the company's philosophy is, and what they're doing to engage that philosophy than you might read in an annual report. All right, annual reports are very glossy and they're very pretty, and they also are designed for certain information. But the proxy statement is a lot of cold hard facts that if you can get through them, they'll explain to you a lot about what's going on and why it's going on at that company. So we've talked a lot about executive compensation. So let's shift our discussion on a couple of other topics of corporate governance that shareholder activists have really focused on over the last several months and years. I'll give you a couple of examples. Anybody know anything about a little company called Apple? It might sound familiar to you. There was a proposal 2 years ago at Apple put up by CalPERS. Everybody know what CalPERS is? One of the largest unions in the country here in California. They put up a proposal for Apple to adopt a majority voting standard for director elections. In other words, instead of you put all the votes together in something called plurality, which it doesn't, basically everybody gets elected as long as they get votes. This means that they actually have to get more than 50% of shareholders voting to support them each year that they hold a director election. So it's become commonplace, but there's still companies that hold out and do not have the majority vote standard. But it's one of the big things that activist investors are going after right now. So CalPERS put this proposal on, it passed. Now remember, it's not a binding proposal, so Apple really didn't have to do anything. But they did. Earlier this year, at their shareholder meeting, they put together a number of provisions in their governing documents, their bylaws and their corporate documents, in the form of some modifications and some amendments, one of which was to initiate majority voting. So be responsive to shareholders. That's a great thing, right? Well, there was a hedge fund. Anybody heard of hedge funds? They're a little bit popular these days. There's a hedge fund called Greenlight Capital, run by a guy named David Einhorn. They own less than 1% of Apple. As you probably remember, Apple's share price really took a tumble last fall. But they had, $137 billion on their balance sheet in cash. And David Einhorn and Greenlight Capital wanted to see Apple return more of that cash to shareholders. Apple's already paying a fairly sizable dividend, but they wanted to see a bigger dividend. In fact, they wanted to see a new set of shares, a new class of shares, that would guarantee a dividend at a certain rate going forward for a certain period of time. So Greenlight decided that they read the proposal that Apple put on their ballot. One of the things that Apple did was to try to do this majority voting provision. The other thing they tried to do was to eliminate multiple classes of shares. One share, one class, one vote, one shareholder. Very simple, very much preferred generally. Greenlight didn't think that was appropriate because they wanted them to issue this special preferred class of stock that carried with it as a 4% dividend. So they sued to enjoin Apple from being able to put this shareholder proposal on their ballot. And they used the method that basically they said because they bundled the proposals together, so there were three or four different provisions that Apple was trying to fix in their corporate documents. Technically, you can't do that. Each one has to be a separate provision. But it wasn't because Apple was trying to be sneaky. They were trying to be responsive to shareholders, and the cleanest way and the quickest way to do that was to simply put everything under one proposal because it was all shareholder friendly, with the exception, in this case, of Greenlight Capital. And so they sued, and they won. Prior to the lawsuit decision coming out, the proposal was carrying a majority vote. It was carrying 98% support, which, as it well should, right? It was good things for everybody. But essentially, you then had a hedge fund that owned 1% who was able to stop Apple from doing this because they had a specific agenda. They wanted to see more cash back to shareholders. Guess what? So did we. We had meetings with Apple. We had meetings with Einhorn. We talked about it. We wanted the same thing. But nothing that he was proposing was going to preclude Apple from paying more dividend. They could do that. Even after the proposal about multiple classes of shares passed, they could still issue more, higher dividends. And by the way, they've subsequently done that. And you now have other investors, major kind of activist investors, who are still asking for more of that cash. That's a story for another day. But the question is, should a minority shareholder, 1%, be able to override a 98% support for a provision that probably would have been beneficial for all of us as long-term shareholders? I don't know the answer to that, but based on kind of my attitude as I've gone through this tonight, you can guess my stance on this. But that's something that we deal with all the time. That's what activism can do for you. So the question is activism good or is it not? And every case is a little bit different. But my sense is that this was a bad move, and it was bad for Apple and bad for its shareholders. Now, Apple subsequently come out with the 5C and the 5S, and things look a little bit brighter. And they're giving more money back to shareholders in the form of a dividend. But did Apple really need to spend resources to try to defend itself from in a lawsuit for a provision that would have been beneficial, arguably, I guess, but generally was thought to have been beneficial for shareholders? Those are the things that really you have to kind of think about and decide which side of this fence, which side of this war do you want to be on. Another example is this other little company called JP Chase. You probably heard of them. They had a little debacle called the London Whale. So that trading disaster, and this is a different provision. This is one that I mentioned earlier called the separation of the chairman and CEO positions. Most companies in America have the positions combined. So if the CEO is usually the chairman of the board. What does the chairman of the board do? He runs the board. Who's the CEO accountable to? The board. But if the CEO is also the chairman, who's overseeing the CEO? And that's the ultimate question. So in the case of JP Chase, they lost a paltry $6 billion as a result of the bad hedging trades. They've recently agreed to pay $920 million in fees and fines. But at the end of the day, and this was admitted by Jamie Dimon, it was subsequently admitted by some of the board members, it was a lack of risk oversight by the board and the Office of the Chief Investment Officer and the CEO that led to all of this. So everybody was culpable. Nobody was innocent in all of this. So earlier this year, there was a shareholder proposal coming out of another pension fund that wanted to separate the chair and CEO. These are very common. They rarely win majority support. They do periodically, but generally they get maybe 30, 40% in support. This was a big deal because Jamie Dimon is the face of JP Chase. Jamie Dimon is one of the smartest guys on the planet, and Chase was one of the banks that essentially, was able to weather the financial crisis and made millions and millions of dollars for its shareholders. So whether you like Jamie Dimon or not, he was largely responsible for the success of JP Chase. Here's the problem. Nobody wants to give up a position, especially one as lucrative as the board chair of JP Chase. So initially, this proposal was tracking support of around 53%. So that's really good for this type of proposal. Once JP Morgan had a sense of where this was going, and now I'm going to hedge all this with allegedly, there is an organization called SIFMA. It's the Securities Industry and Financial Markets Association. Basically, it's made up of financial advisors, broker-dealers, and a lot of folks a lot like JP Chase. Allegedly, they pressured the company that essentially issues proxy ballots to shareholders and communication to shareholders about proxy issues leading up to a shareholder meeting. They allegedly put pressure on this company and said, look, there's no agreement that you have that you can send out information in support of this proposal on behalf of the shareholder proponents, the people that are putting this proposal up. Now this is something that this company, they're called Broadridge Investor Services. They've been doing this kind of thing for years. If a shareholder would put out a proposal, the shareholder would send its communications to Broadridge, and Broadridge would disseminate it to the shareholder community so they You'd get better sense, better traction on their proposal. There was never any specific agreement, nothing was signed, they just did this and they've been doing it for years. And it was essentially kind of a good faith mechanism to give equal distribution of information on both sides of the issue. But SIFMA allegedly put pressure on Broadridge and basically said, stop. You can no longer send material in support of this proposal. And Broadridge was stuck between a rock and a hard place because they didn't have a formal agreement in place and they were doing this basically voluntarily. They stopped. Long and the short of this is, and complicating this, by the way, is that Jamie Dimon kind of hints that if this thing passes, he's going to resign as CEO of JP Morgan Chase. Well, you can imagine then what happens. Jamie Dimon, the face of JP Morgan Chase, he's responsible, not single-handedly certainly, but very responsible for all the success of not all the success, but a good amount of the success of the bank over time during his tenure. As shareholders, we can't let that happen. He is JP Morgan Chase. The bank will go into a tailspin. We don't know who his successor would be. We don't know that there's a good succession plan in place. We can't let this happen. So the next thing you know, from a slightly more than 50% majority of support, by the end of the day, by the time the shareholder meeting was held, the support had dropped to 32%. The proposal failed. Jamie Dimon kept his 2 roles as chairman and CEO, and the bank went on to post record profits again. Here we go, double-edged sword. So here's the question. So how's this different from Apple? Right? In Apple's case, you had an external force, a shareholder, who in 1% saying, I want you company to do this my way. And if you don't, I'm going to sue you. And they did. In this case, you have the company defending itself. Believe me, most of the time, these things don't make the media. A separation of chairman and CEO proposal doesn't get nearly the media event that this did at JP Morgan Chase. So here's the question. Did JP Morgan act responsibly? Did they act ethically? Did they act within the bounds of good corporate governance? Was it right for him to hint that he might resign? I mean, some people took that as a threat. I think it was a very real threat. I don't know that he would have gone through with it, but I think it was real enough for shareholders to have pause. And clearly, as a result, they voted down the proposal. So, again, double-edged sword. On the one hand, there are good reasons to separate the chair and CEO for accountability. On the other hand, what do you do when you've got a Jamie Dimon in the room and he's running the company and running the board? That's a tough call. Again, I told you there are going to be more questions than answers. So these are the things you kind of have to think about as you think about corporate governance. So at the end of the day, the ultimate question is, where does this leave us? Right? Some people would argue that all these provisions have accelerated the rise in shareholder activism. I think that's a fair statement. Since companies are now required to be more transparent, they're required to disclose more, and shareholders, frankly, just have a lot more power than they ever have. Particularly we as institutional shareholders, but never forget you as individual shareholders have that power too. And so more of us are willing to utilize our votes to help try to influence companies in the way they think. Now, is it our job to run a company, shareholders? Some people would argue, yeah, that's our right. Personally, I would argue that being a shareholder, owning shares is not a democracy. What you do is you vote to hire the board, who in turn hires the management team, who in turn runs the company. I think it's important to keep those distinctions in mind. Again, this is my personal view. That being said, I think as a shareholder, we have the right to tell people what we think. I think this is still America, and so I think we still have that freedom. So I think it's an important right, and we need to exercise it. And these provisions have allowed us more opportunity than we've ever had historically to exercise that right. I think that the idea of having annual elections, the right to call special shareholder meetings, separating the roles of chairman and CEO, tying executive compensation to the results of the company, I think those are all key factors that we're all going to have an opportunity to have a voice in as we go forward. But then again, the question comes back, have we gone too far? Usually these things, just like a pendulum, they swing. This thing in a lot of ways is swung completely to the other side. Again, it goes back to my question. Is owning shares a democracy? That's a question you have to answer for yourself. But in some ways, the second decade of the 21st century is a lot like the kind of crazy days of the 80s. The stakes are higher. There's still Gordon Geckos out there. I think arguably they have even more power than they did back then, and we thought they had a lot of power. But the great thing about all of this, you got to remember there's always a flip side to every one of these arguments, and that is more dialogue between corporations and shareholders. more opportunities for us to speak our minds, not only in the proxy statement, but in other ways. And I think it's incumbent upon all of us to do that. I mean, my colleagues and I spend literally thousands of hours talking to companies about corporate governance. That's our jobs. And I think, I think we make changes. I really do. I've seen the results. I've seen companies come back to us with ideas and proposals, for example, in their executive compensation policies. They want to run by us. They want us to take a look and see if they meet the sniff test. Do they make sense? Now, like I said before, somebody who's making $50 million, it's going to be pretty hard for them not to make $50 million going by. So you have to accept the fact that they're going to chip away at this. It's almost tilting like windmills. I hope it's not. I think we're making progress, and I think it's important. I'll close my prepared remarks, and then hopefully we'll get a little bit of a discussion with another of my favorite films and a scene from that film. Anybody remember? Now I'm going to date myself again on this one. Anybody remember City Slickers with Billy Crystal? Okay, remember the scene where he and Jack Palance are kind of riding down they're riding along, and they have a surprisingly earnest and thoughtful conversation, and it goes something like this. You remember that Curly was the name of Jack Palance's character, and Mitch was the Billy Crystal character. And Curly says, "Do you know what the secret to life is?" And Mitch says, of course, "No, what?" And he's excited because he's going to learn it, and he's happy, and maybe he'll get something out of this cattle ride. And Curly says, "This," and he holds up his finger. And of course, Mitch says, "Your finger?" And he says, "No, it's one thing, just one thing. You stick to that, and everything else doesn't mean a thing." And Mitch says, "Well, that's great. What's the one thing?" And Curly says, "Well, that's what you got to figure out." And at the end of the day, it looks like both sides are winning a little bit of the battle of the corporate governance war, right? Every day is a little bit, one side wins a little here, the other side wins a little there. But who ultimately wins? I don't know. It's anybody's guess. Should you care? Well, I care because I get paid to. I think we all should care. I think it's important. I think it's important for, frankly, and I'm not going to get too patriotic here, but I think it's important for America. I think it's important for the world. I think it's important to care. And I think this is an opportunity to care. And as Curly said, this is the one thing we've got to figure out. Thank you very much. I have to use this because apparently I'm on camera. How far can I walk?
To the end of the stage.
Oh, I can walk to the end. Okay, somebody argue with me. Somebody tell me I'm crazy. Somebody ask me a question about mutual funds or corporate governance. Come on, there's no such. I'm going to make them lock the doors. Look at these guys. Look at this student. I'm not sure. You guys are waiting about 60, 70 pounds, maybe 100. It's not going to let me pull this one. Yes, sir.
Why such a difference between Asian corporations, let's say Japan, where a president or a CEO only makes 7 times more money than the average worker in the United States? The difference is over 300% difference between the worker at the bottom and a corporate CEO.
So in other words, the question is, Japan seems to have a better system.
Obviously, I think it brings more balance when you look at their whole structure
right.
of a corporation, even through bad times as they just went through the disaster 2 years ago. The corporation still maintained over 60% of its equity in the companies, even though it suffered dramatically.
Yeah, it's a couple of reasons. Number one, it's a history, it's a cultural history. I mean, that's the main answer. A lot of these companies, and you know this as well as I do, are family. I mean, they've still got family members in them 50, 60, 70, 100 years later. There's a cultural bias in Asia in particular to not be ostentatious, to not be, let's just say not be greedy, because it's frowned upon culturally. Now, the flip side of this is, in Japan, there are virtually no independent directors. It's the ultimate, good old boys club. They all know each other, and they've all worked in different companies that they've also served on boards of before and been executives of. So that's kind of the flip side of that, right? There isn't a lot of independence as far as how we think about independence and how boards should be. And some of that kind of trickles down into why you see, despite the fact that Japan is, technologically has made huge progress, obviously, and is a world leader, But from a corporate perspective, the structure that you see today is essentially the corporate structure you saw 50 years ago. So they really haven't made the advances, but that's one of the reasons. It's a cultural history that, frankly, as shareholders, we're trying to make inroads into. We think that they would benefit from having some outside influence from independent directors, just from an operational perspective. But that's a real hard thing. It's an attitudinal area. It's really tough to break into. But they've been successful. But I think that tide is changing because leadership is starting to recognize that they can't remain in that kind of situation forever. So we'll see. But that's going to be a really long road going forward. So, my favorite audience member, yes.
But when you're talking about the 7 times, and you're talking about Larry Ellison, and he is Oracle, right? They said his name right. And so they're willing to pay him perhaps stock options, particularly stock options, because even that, then he has to get the value of the stock higher later on because he makes more money. But the fact that we pay in stock, and we pay so much in stock, is actually long-term not beneficial to American corporations because they're all looking for the short increase in the stock value, as opposed to where they would not be as concerned with the short-term value increase because they're only making 7 times. They're keeping money in the corporation, which allows the corporation to weather bad times and to reinvest, because part of the reason Apple wanted to keep that money was so that they could invest in technology and long-term grow the value of the stock. So when you talk about it as though it's not so desirable and we've made improvements, have we really made improvements?
Well, what you're talking about, and it's a great question, is that long-term, what's long-term value? Obviously, most of everything we deal with today is very short-term. It's very quick. People don't want to spend time, and that's why mutual funds are struggling because people don't want to wait 10 years to double their investment at 8%. They want to double their investment in 1 or 2 years and move on and stick it in something else. That's what gave hedge funds a bad name because they were short-term, nearsighted, and all of that. Now, that's changing. There are a number of hedge funds that we interact with that we actually would agree with some of their philosophies and what they're trying to accomplish. Hedge funds are becoming more like mutual funds in some ways and are looking more long-term. That's the key element. Your point is, how can we be long-term investors when everybody wants to flip and make a quick dime?
But see, it seems to me the short-term investing is what helped cause the bubble. Because even in our tax structure, it used to be that long-term capital gains were more preferential than short-term capital gains, and now there doesn't really seem to be that distinction. So everything is short-term, and that's what causes bubbles, because people want to flip, 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 and then eventually the bubble breaks. Would people actually prefer, because, I was talking to a Tea Partier about something, and he claims that economic growth under Republicans was like 20%, 20%, 20%. But then we have a recession at the end of it, whereas opposed to something like Obama at 6.7% over each year. How many people would actually prefer to have an 8% growth rate if it's guaranteed over 60 years as opposed to 20, 20, 20, and then you lose 3 times what you invested?
You have the 8%. I don't disagree with you. And I agree with your thesis that short-termism has caused a lot of, clearly caused the bubbles and a lot of the grief. Same thing happened in the housing market. All of us have experienced some part of that over time. You're absolutely right. So it's another question. Who do you want to be? Do you want to be a long-term investor that looks out past a year and some kind of profitability? Or do you want to make a quick buck? I'm looking at these good students who are going to be the rulers of the world soon. When I'm an old guy, hopefully having a pension that's still funded. Who do you want to be? Do you want to be the person who thinks long term, that wants to reinvest in what you're trying to see happen, or do you want to just flip it because you can make a quick buck and move on? That's not a new question. That question's been around forever. Again, I don't disagree with the thing you said there. Absolutely. So, what else? Okay,
Yeah,
so this is a plant. Look at this.
Thanks for a wonderful talk. I'm thinking of Google as maybe a different organizational chart. They're more of a matrix as opposed to the traditional top-down management structure.
They also have multiple classes of shares.
And they went to the auction format for their IPO, and they don't report quarterly, and they don't play that game. Is that being duplicated? And I think it might have hurt them a little bit when they tried to split their stock, I guess that must have been a proposal that went down the flame.
Yeah, I think it is in some cases. It's a model that worked, you know. It's like anything else, success breeds success. I think a lot of entrepreneurial folks see that model and say, look, it's worked for Google, why wouldn't it work for us? It works to a point. Again, multiple classes of shares where basically the guys at the top are incumbent and are going to stay incumbent in perpetuity. I think that's a problem, personally. The flip side of that is you knew that when you invested in Google. So it's kind of hard to then say, well, okay, you should change that when it was okay when you invested in the IPO and it probably flipped a nice handsome profit over time. But yeah, I think that model probably is being duplicated. But at the same time, I think people are seeing what the pitfalls are, and they realize, for example, what the reaction was to that secondary class of stock and what it meant for investors long term, which basically meant investors didn't have much power in trying to influence how Google is run over time. I think the next generation is going to profit from that, and I think will benefit from deciding whether or not that continues to be an appropriate model. But then like anything else, my crystal ball is a little bit fuzzy. I don't know about yours. If you know anything more than I do, please come up afterwards and let me know. I can always use a good stock pick. What else? Anybody disagree with anything I said vehemently? This man always good. You look nice to disagree with me.
Yeah.
Well, I'm going to ask you something about Jamie Dimon, but before I get there, I was going to ask you something. In your response to the gentleman who talked about Japan, you said it was quite a bit of a cultural thing, and maybe the difference between Japan and America is starker than the difference between America and Europe. But Europe also tends to be, the ratio of CEO pay to the median worker is much lower. Right. And even going back in time in American history, going back to the 60s and 70s, arguably there was a much, the disparity was much less. And how much would you attribute the change in American compensation policy, going for pay for performance and so on, to the agency theory literature that came out sometime in the 70s and 80s? And why do you think America has adopted this sort of pay for performance structure much more than the other countries have? Kind of going to a winner-take-all kind of model, and which has also, in some sense, exacerbated overall income inequality. So there are a lot of things here, but I suspect there is something that American corporations and American corporate governance did that the rest of the world did not quite follow along. Maybe they are coming there, but not quite yet.
Well, it goes back to my point about how shareholders really were not empowered early on. I mean, early in America, they were. Early in the Industrial Revolution, they were. They lost sight of that over time. It's now come back. It's now vogue. In the 70s, and again, it comes back to culture. What we have to remember is that in Europe, and in the UK in particular, shareholders have had a voice, and an active voice in governance for many more years than they have here in the United States. And again, it goes back to a business culture. It's similar to my point about Asia. There's an inherent business culture that says, shareholders are exactly that. We need to listen to them. And by the way, they're very active and vocal. Part of the problem is also that there's this country is a rules-based environment, right? In the UK and in Europe, it's not about rules per se. It's about basically suggesting how things should go. And again, it's a philosophical difference. At its core, they don't have the type of rules that the SEC enforces. They don't have the lawsuits that we have here. Think about this: say on pay. A lot of companies who failed say on pay votes were sued by one law firm in particular, because they didn't disclose, allegedly, enough information in their proxy statement for shareholders to make, number one, an informed decision, and two, they were paying executives excessively. Those, by and large, with one or two exceptions, have been thrown out, because let's face it, if you haven't read a proxy statement lately, they're anywhere from 70 to 150 pages long. I think there's plenty of disclosure, and remember, the more you say, the more you have to say. So the idea that they didn't say enough is just patently absurd, and luckily the courts agreed with that. The problem is many companies just settled financially with this one law firm, and it's paved the way for some just really bad situations occurring. But to your earlier point, where did we take a left turn? I can't tell you that. I mean, I think,
right turn.
or right, yeah. Greed is a big motivator, right? When the dollars get so excessive, it's kind of hard to turn that, again, to my earlier point, it's kind of hard to back out. I'd love to see every NBA player take a 20% pay cut so I could go to the Lakers game again. Is it going to happen? Is Kobe going to, and this is not an indictment on Kobe, is he going to take a pay cut? Maybe. I know Magic took a pay cut. You know, it happens once in a while, but you know, by and large, they're not going to take, Jim Buss isn't going to take a pay cut. So, the Laker tickets are still going to be out. I'm not going to be able to go. So that's on him. Yes. Yes, ma'am.
As regards to, has anyone ever done any studies comparing the percentage of people who own stock in the countries and in their corporations? Because I'm wondering if part of it is the disparity and that only rich people now own stock and their big concern is just making a profit as opposed to other maybe socially responsible things.
Let me turn the question on. How many of you own a 401k? How many of you own an IRA of income? How many of you have a pension plan? I don't, is it concentrated? Sure, it's well concentrated in the top 1%. Yeah, no doubt about it. But we're all participants in the free market system, right? The question is who has the power? And unfortunately, I mean, even though I said stock ownership isn't a democracy, who are they going to listen to? Who's corporate America mostly going to listen to?
The corporate investors.
Correct. For better or worse, that's why it's incumbent upon us as fiduciaries to try to make good, solid decisions and ask the right questions. And that's a tough job to do. I mean, that's hard to do. That's why I'm not an investment analyst. I just tag along with it and go for meetings. Yes, sir.
I just want to be devil's advocate. Not everybody in Europe. I have no issues actually with a CEO or a corporate person making that much money as long as they're investing properly, obviously. I think the biggest problem I have is with a corporation in Europe, for example, when it comes to paying back to the government or their country, they get taxed 30%, and correct me if I'm wrong, because in the United States, the average corporation pays about 8%. Big, drastic numbers. As a CEO in Europe, you're going to be in power for about 20 years. Therefore, you are looking for a long-term period, versus here, a CEO can be in power for 3 years, depending on the contract that they have. So they're going to try and make as much money as possible in that time frame that they have, versus when they leave, they have that golden parachute that we talked about. The problem is that when they want to leave, they don't want to pay taxes, or they want to pay over 14% taxes, versus the average American pays about 30%. So I think that's where the biggest discrepancy is, how we see our democracy, which is beautiful if it's under control, how appropriate it is. And then when we talk about sports again, the basketball players are not going to lose money. Why are they going to lose money when they raise so many people? Even though you and I may not be able to afford it, there's somebody that will. The problem is that there's no equilibrium between the owners and the basketball players in the community to be able to balance everything out.
Well, I mean, you hit the tax structure of the U.S., obviously, I'm not going to say anything that everybody knows, is complex, and most people would argue not right in a number of ways. And it seems like other countries seem to get it right because they have an inherent philosophy, and going back to this culturalism, that, that's steeped in history. We do too, but again, we've made it. Part of this is to try to make it easier on companies to again make money over time. This is all about making money. Now, I'm not saying that companies don't come into being to do good things, to produce great whatever, fill in the blank. They do. That's important. But if you can make millions of dollars doing it, wouldn't you?
Right.
I mean, I don't know that anybody in this room, now you could do whatever you want with the money after you got it, but I think the idea that if your company makes money, I should make money, my shareholders should make money, that's a pretty tough attitudinal barrier to overcome. So I'm going to go to this gentleman in the back.
One of the big differences between the United States CEOs and other country CEOs is we tend to reward our shareholders or our CEOs if they're charismatic and if they bring a lot of attention to an organization. Gentleman's right, they stay for a couple of years and then move on, they take that charisma and take it to another company. How many CEOs of large corporations in Europe do you know the name of? I'm not going to ask you because I'm sure you know, but who knows the name of the CEO for Bayer? Who knows the name of the CEO for Mercedes-Benz? Or Nissan? But yet in the United States, we know all these names because they are personalities, they are celebrities, they are people that draw attention to the company and artificially raise stock prices. And that's one of the ways that they earn their compensation.
Yeah, I can't disagree with that. I think you have to be careful how much you attribute to their you know, kind of to their fame, but there is a component there. There's no doubt. And you know, if you can make in 3 years what most people would make in 2 lifetimes, you know, that's kind of tough. You know, that's kind of tough to argue against. And it comes back to, again, nature, right? It comes back to human nature. What do you want to accomplish? Who do you want to be? How do you want companies to operate? What are, you know, from a philosophical standpoint and an ethical standpoint, you know, what line in the sand are you going to draw? And I think each one of us is going to come out with a little bit of a different answer. Now that doesn't mean we shouldn't have Jamie Dimon's and Larry Ellison's, because I think we absolutely have to have those guys. I mean, they are hugely responsible, you know, for creating wealth and for, you know, making us all, you know, successful in our investments.
And they add tremendously to the body of knowledge, and they create a tremendous amount of innovation.
You betcha. And they win the America's Cup. So, you can't discount that.
I think
I'm getting a hook.
the string of your question seems to imply some question of fairness. Is it fair for them to get this amount of money for whatever it is that they did? And I think as shareholders, have you seen conversations on fairness arise? Because I think when you talked about the fulfillment of your responsibilities, your fiduciary responsibilities, you are doing something that is expected of you. But have more and more of the conversations around boards that you have listened to revolve around questions of what is fair? Or is that something that is still taboo or forbidden?
Well, I'm going to quote, and if one of my colleagues is watching the live stream now, she's going to smile. One of my former boss's favorite lines was, "Fair is not equal."
Equitable is the right word. Right?
I couldn't tell him that. He was my boss. But you know, to your point, I guess, you know, the short answer is we don't really talk about fairness in that context. It comes up with the idea, and I mentioned it earlier. If you're talking about a Larry Ellison, is he worth $91 million? You could say, is that fair? I don't know the answer to that. Is he worth $91 million? I don't know the answer to that. So I mean, I don't mean to skirt the question, but I don't know the answer. I mean, there's a part of me that inside says, heck no, it's not fair. Shoot, I'm not going to get $91 million. At the same time, I'm not as brilliant as Larry Ellison, so I don't deserve it. That's, you know, that's the bottom line for me personally. But the conversations revolve around the concept without necessarily saying the word. Okay? What's fair, what's right? It goes back to the whole concept of what the Venta Center is about, and that is who are we and what are we about and how do we act responsibly, right? Fairness is a real nebulous concept. I think it's fair to ask the question, but I don't know what's fair. You know, again, fair is not equal, or is not, I'm sorry, what was it? Fair is not equitable.
Well, no, I was going to say fair is not equal. It's equitable. That's
right.
What it is.
Right, that's the point. What my boss was saying is, look, you know, you're not all going to be equal, but I'm going to try to treat it fairly. And I think if you think about it and frame it up in that context, right? I mean, you think about how you want to invest in corporate America. I think that's a reasonable way to think about it. I think that's a reasonable way to think about life. You know, again, I have an 8-year-old and a 5-year-old. I think about this. I think about fairness all the time, especially when my 8-year-old says the 5-year-old got something she didn't. Which, by the way, happens. Apparently, there is no equality or fairness when you're an 8-year-old. But it's a reasonable question, and it is one that I think is going to become more and more prevalent as these issues continue to play out over time. This young man, because he hasn't asked anything yet.
How would you suggest individual investors create a more educated gauge on what they think the compensation should be? Because when I hear 91 million, I don't throw any prior thought really into it. It's just a gut feeling. Mm-hmm. And it's not like there's a threshold for me where I'd say, okay, 90 million, but 91's pushing it. How do you develop a more educated sense?
This goes back to Billy Crystal. You know, it's just, you know, we're each going to kind of come up with a benchmark, right? I mean, in no circumstances that I can think of on this planet is 91 million not astronomical to me personally. You know, you can just, you know, what you do is you look out there and you look at the numbers and say, what does the average CEO make? Okay? Throw out, do what you do in your statistics classes, right? Kind of same thing. You're throwing out the highs and the lows. I mean, it's kind of a pretty straightforward analysis if you think about it that way. And go out and look and pick an industry. If there's an industry that you kind of want to benchmark yourself against, because what CEOs get paid in Silicon Valley are very different than what CEOs get paid in the Midwest, regardless of what company they're working for, whether it's a Fortune, Fortune 500 company, whether it's an S&P 500 company. It's very different. So that's another thing you kind of have to take into account. What is the company doing, and what kind of technology is involved? I'll just tell you, benchmark for me is about $10 million, right? If I worked for 20 years as a CEO at $10 million a year, I'd be buying an island like Larry Ellison. I mean, think about that. I mean, this is all overly simplified. None of these answers are simple. The questions are infinitely complex. So you kind of just have to, just pull down the statistics and start running the numbers. And a lot of it does come down to a gut. What do you think that the compensation advisors, I mean, they do the same thing. They run the numbers of the peer group that they're using to benchmark a particular CEO, and that's allegedly one of the culprits for why CEO compensations continue to rise, because every time somebody gets a raise, everybody else in the peer group has to get a raise too. And then it just goes and goes, and there you go. So you have to decide, okay, look, this is my benchmark. I'm going to pick a number. And then I'm going to look out there and see who's at that number. Maybe they're a lot, and maybe if there aren't, okay. But maybe you go it alone. Maybe when you're CEO, maybe $5 million is enough for you, or you take $5 million of that $10 million and you turn it back into some kind of social program, right? I mean, there's a lot of different ways to slice and dice this. What you had?
The only question that I had is I wonder if it might make sense to have some sort of a return on investment on a CEO's pay. They're typically, their pay is an investment in the future of the company. Yeah. You're betting on the company that they're going to do something special to earn that income and keep returning the company. Yeah,
those numbers get run. I mean, they exist. I mean, that's part of the analysis. More and more of our analysts are looking at it that way, and trying to really understand at the margin, incrementally, what is this extra, it's no longer $1, $1 million. What is that resulted for us as shareholders over the long term? And so, yeah, I mean, you're spot on. That's a very key part of the analysis now. Have we solved it? I'm sorry.
Getting back to shareholder activism,
yeah.
What's your opinion on people such as Carl Icahn, Bill Ackman, David Einhorn, who use the guise of shareholder activism to push their agendas forward? Are they really beneficial in getting the
well, Icahn, the question was, are activist investors like, the big, talking about your Hollywood types, the big things like Carl Icahn, they're guys that have been around and doing this a long time. Icahn sat down with, the CEO of Apple over dinner last week and tweeted that, he was receptive to the idea of paying more in dividends. So I think so. I think today, if you asked me the question 10 years ago or even 5 years ago, I think the answer would be not so much. I think the tide is changing, and I do think that the professional activist investor, these are smart guys. I think they're philosophically changing their tune because they see that the kind of the old way of thinking about this stuff just can't work anymore. Now, that doesn't mean some of them still aren't out there and trying to, go no further than Herbalife to see, what happened, when Bill Ackman lost a ton of money as a result of trying to prove that Herbalife was a Ponzi scheme, at the end of the day. But, as a shareholder, I'd be disappointed if it was just about the money. I'd like to think that it wasn't just about the money, but I don't know that. So a couple more hands. Yes, ma'am.
When shareholder activism and what he's talking about, it's like making sure that they're properly stated financial, that they're not doing what banks did and things like that, right? Are there many shareholder activists who actually make sure they're like something like Ben and Jerry, or there's actually a social conscience to some of these corporations so that they don't do like what Enron did, they do positive things? Am I making sense?
Yeah. Okay. Well, you're asking if activist investors have a conscience.
Well, no, I mean, there's a different type of, it seems like, activism. Okay, one's to make sure that dividends are paid back to the shareholders, and another thing's to make sure they're not engaging in criminal activities, that they're doing positive things for the environment, or
you know, as part of their thesis, I can't tell you that that happens all the time. I'm sure that there's some component of their thesis as they think about this that does take into account that, because you can't escape it. You can't not think about that. You can't think about social responsibility, the environment. You have to take that into account. But at the end of the day, they're about creating long-term shareholder value, right? And so it comes down to a question of how you want to do that. There are socially responsible mutual funds. If you are someone who really is committed to the types of philosophies, you know, underlying what you're talking about, and you can invest in those. Whether activists, you know, that's their, you know, my sense is that's not their primary motivation. But they have to do some analysis, because you just can't turn it aside today. So. Yes, sir.
Quick question. I was never a business major, so maybe senior in the name. But in medicine, we're going to say put forth a research protocol. We submit it to an ethics agency committee, usually it's university-based, locally. They sign off on it or they don't. Their opinion is based not on the ethics from a medical standpoint, as much as philosophically across the committees are usually philosophy majors and biologists, wider range of people. But if they don't sign off on it, then it's not done. Is there any oversight in business that would duplicate that kind of?
Well, you know, it depends on the industry, obviously. I think certain industries, and, you know, here we go with the federal government. I mean, right, isn't that really what the federal government's job is supposed to be, assuming that they're actually...
They don't do it well. They do it on a legal basis, and we all know there's wide separation between legal and ethical.
Yeah.
So,
if your question is there some kind of an ethical oversight body in corporate America? Sadly, the answer is probably no, but a lot of people would tell you that you have to be careful about that issue. Again, the whole idea of ethics, corporate culture, and doing the right thing, these are, you know, all of these can be slippery slopes, right? You have to be careful, because I mean, what do we ultimately, as shareholders, hope that we're getting? Good return on our investment. I'm not aware of any. I'm sure there are probably some that exist on an industry by industry basis, but in terms of kind of ethical oversight, it doesn't, to my knowledge, doesn't exist. So, maybe you just found your next career. Anyway, thank you all very much. Great dialogue. I appreciate the questions. Hopefully you have more questions going away. I know I do. And I thank you for having me. It was a really nice evening.
Chad, on behalf of the Banta Center and the School of Business Speakers Bureau, we want to present you with some swag, as we say.
I don't know, is this ethical? I don't know. I just want to call into question my...
This is a gift. If you want to disclose the fair
Okay,
market value of your
and you know what I love the best? The wrapping. I can always count on... See, I told you, why am I getting invited back to campus? This is, you know, this is the kind of wrapping that is perfect for me.
This is where your daughter is.
Is this really? Okay. Oh, look at that. They're going to love
Little
that.
bulldogs. We hope to see them here in a few years.
Future bulldogs, no doubt about it. No doubt about it.
And we have a gift certificate
That's
here
awesome.
that hopefully you can invest in your favorite sports team, and we'll hear that's the San Francisco Giants.
No, well, yeah, well, right now, the irony is, I switch allegiances. If the Giants are in the playoffs, it's the Giants. If not, it's the Oakland A's, because truly the A's were my first professional game that I ever went to as a kid. And so I'm an A's fan, even though sometimes a closeted A's fan.
We're delighted to have you here, and thank you very much for all your time and effort to
Appreciate
come out
that.
and speak to
Thanks very
us
much.
this evening.
I'll tell you, the girls, we have something called the magic suitcase. Whenever I go on a business trip, there's always got to be something coming out of the magic suitcase. In this case, I didn't have to go very far away, and it's going to come out of the magic plastic bag. That's all.